Hello, financial enthusiasts! Welcome back to Stock Market Catalyst, where we reveal the secrets to financial success in building a solid foundation for a brighter future. Let's now discuss one of our favorites, methods for the quick option, in which we would make an opening transaction by selling an option. A put option allows the option holder the chance to profit in the event that the option's price decreases. A put option provides the holder the right, but not the obligation, to sell shares of stock at a predetermined price, known as the strike price, on or before a specified expiration date. When you purchase a put option, you're essentially buying the right to sell stock. However, in trading, you have the flexibility to take either side of the trade. This means you can also sell an option as their initial trade, a practice referred to as being short the option. This position reflects a belief that the option is overvalued and its price will decline. Unlike the scenario where you profit from the price of an option rising, as seen when buying an option, selling an option aims to generate profits from the option's price declining. To achieve this, you would initiate the trade by selling the option at a higher price and later buying it back at a lower price to close the position. When you sell an option, you're essentially transferring the right to someone else, the right to sell stock at a certain price. This means you're taking on their associated risk and you receive compensation for doing so. Drawing an analogy, selling a put option is akin to providing insurance. Imagine you sell a put option and subsequently the stock experiences a sharp decline, prompting the option holder to exercise their right to sell the stock at the strike price. Since you initially sold them this right, you are obligated to buy the shares from them at the agreed upon strike price. This scenario mirrors how an insurance provider would prefer a client not to make a claim. Selling a put option is a bullish to neutral strategy where you hope for the stock to increase in value or at the very least remain above the strike price. Similarly, you can opt to sell a call option as an initial trade following the same concept. However, in this case, you would be aiming for the stock to remain below the strike price. Selling a call option represents a bearish to neutral approach. To illustrate, consider the example of a 125 strike call option. The option is priced at around $102 with 4 to 6 days until expiration. Suppose we sold one contract of this call option for $102. Given that option prices typically have a multiplier of 100, this equates to collecting $102 for selling the option. Let's now examine a variety of scenarios and discuss both the profit potential and potential losses associated with this trade. First, consider a situation where the stock's movement is relatively subdued, possibly trading sideways or experiencing a modest increase, reaching a final value of, let's say, $122 per share. In this case, the call option at the 125 strike would be considered out of the money and consequently worthless. In this scenario, the $102 premium we received to initiate the trade becomes our retained profit. Whether the stock remains unchanged, slightly increases, or even decreases, as long as it remains below the short call strike of $125, we attain the maximum profit of $102, equivalent to the premium received when opening the trade. However, this approach has its merits. In exchange for shouldering substantial risk and capping potential profits, the short option strategy offers a compelling probability of profit. It provides an alternative perspective to buying options where the risk is comparatively limited but the profit potential is boundless. Selling options essentially incorporates higher chances of profit with defined risk, while purchasing options entails the inverse. It's imperative to acknowledge that although the notion of selling options may seem risk-laden, the theoretical risk often surpasses the actual risk. The strategy involves balancing the potential for substantial losses with the benefit of a high likelihood of profitability. This is why the short option strategy garners both attention and controversy. Let's proceed to implementing these concepts in actual trades. We'll execute two separate trades, involving a short call and a short put. To illustrate, we'll engage in a short call trade on Caterpillar, denoted by the ticker symbol CAT. As the stock currently hovers around $95 per share, we'll initiate a bet that the stock will remain below a chosen level. This level, determined by the strike price, guides our trade direction. Switching gears, let's delve into the option chain to identify suitable options for trading. We'll concentrate on the December expiration with approximately 11 days remaining. By referencing the delta and probability in the money figures, we discern the likelihood of the option finishing in or out of the money. The delta approximates the probability of the stock being above or below a certain level, thereby aiding us in strike selection. Subsequently, we choose the 99 strike call option for Caterpillar, exhibiting an 84% chance of expiring out of the money. We initiate the trade by selling the option, signifying our expectation that the stock will not reach $99 by expiration. The premium received for this option sale is $0.35, which implies our maximum profit potential. Bear in mind that the capital requirement for selling options differs from that of buying options. Since the theoretical risk when selling options is significant, brokerage firms compute a capital requirement that aligns with the associated risk. This is an essential consideration to understand before entering any trade. Upon executing the trade, we monitor its progress as the days advance towards expiration. The position's profitability is influenced by the stock's movement in relation to the chosen strike price. We also observe how delta evolves, understanding that a growing delta may indicate amplified exposure to price fluctuations. As the trade reaches its culmination, we encounter the reality of expiration. For the short call trade on Caterpillar, the option remains out of the money, rendering it worthless. This results in a profit equivalent to the premium received when initiating the trade. In parallel, we undertook a short put trade on another stock, GDX, employing similar principles. The chosen strike price for the short put was 20, with an associated probability of around 67% for the option to expire out of the money. The premium collected was $0.37. However, as the stock's price fluctuated, the option moved into the money, necessitating a decision. Recognizing the potential transformation of the short put option into a long stock position, we opted to close the position before expiration to avoid this outcome. We observed a loss on this trade due to the change in the option's value from $0.37 to $0.78. By calculating the difference, we determined the amount lost on this specific trade. So that's it. We trust you found the video informative and engaging. If you did, kindly give the thumbs up and consider subscribing to our channel by hitting the button below. Thank you for joining us on this insightful journey into the world of options Greek. In the upcoming video, we'll be exploring the anatomy of cryptocurrency, how it really works. Additionally, don't miss out on our valuable options trading part 5 of the video series. These videos are designed to enhance your trading skills and knowledge, and they won't cost you a dime. And that brings us to the conclusion of our second episode of the Options Trading series. In the upcoming video, Investing for Beginners Options Trading Part 3, we're diving deep into the 3 factors that influence an option's price fluctuation. Now, don't miss our latest video, Investing for Beginners Options Trading Part 1 of our Options Trading series. Here, you'll gain a practical understanding of buying and selling call options and put options. If you haven't already subscribed, make sure to do so and stay tuned for our future videos where we aim to empower you to achieve your financial goals.